Welcome to another epic Sistr webinar. I say epic, nothing to do with Sistr, to do with the people, the experts we get involved. And this one has two very cool human beings, Katherine Gilroy from Seedrs and Claire Lettice from Sistrs. And it's all getting investment ready is the theme. And we're going to start off with Katherine from Seedrs, because having worked with loads of founders and startups and who are all raising money, she is a complete expert in what you need to get investment ready, which is always something massive that scares the hell out of people and stops people launching businesses, actually. And then we'll hear from Claire Lettice, who mother-daughter combo with Lucy, founded Sistrs, and I will let her explain more about that later. So we will get going and hand over to you, Katherine.
Yeah, absolutely. Thanks, Emma. I was saying to Claire yesterday, we've got a bit of a tongue twister or a mouthful of a lineup today with Sistr and Sisters and Seedrs. I won't try and say that too quickly. But yeah, thanks again for having me as part of your Launch Your Business Month here with Sistr. We obviously kicked it off yesterday with a session on making your business dream a reality, and today we're here to talk about what you need to think about when you're looking to take your business to the next level and take on some investment to really start accelerating your growth. It can be a really exciting time, it can also be a really stressful time, and quite often if you're not surrounded by investors or high net worth individuals, it can be really difficult to know where to start. And I know for myself that when I started working in the investment space earlier this year, I felt like everybody was speaking a different language. And I came from the legal world, which is so full of jargon and quite a lot of Latin, actually, and I found it a bit confusing. And so I understand that if you're on the outside looking in, it can feel a bit confusing and actually a bit overwhelming. And so we're going to try and unpack some of that today, so people know what they need to start thinking about and what various bits and pieces mean. Just quickly, for those who may not be so familiar with Seedrs, we are a private equity marketplace across Europe. And what that means is we allow startup companies to raise investment from absolutely anybody. And we allow anyone to invest in those businesses from £10 upwards. And we help businesses that are right at the very start of their journey, all the way through to the likes of Revolut, who I'm sure some of you will have heard of. Now, Seedrs was founded with the aim of democratizing private investment. So prior to a platform like ours, if you were a startup looking to raise investment, it was pretty hard to do that unless you were part of what was typically referred to as an old boys club. And then on the flip side of that, if you were, someone who was looking to back and support these early stage exciting businesses, again, you couldn't even get access to those deals unless you were part of that club. And then when you couple that with, the banks being really reluctant to lend to early stage businesses since the 2008 crash, and the statistic that regardless of gender, only 1% of founders raise capital from VC investors, there had to be another option for the other 99%. And so opening up this investment class was really important generally, but particularly so for people who more often than not did not find themselves in those clubs, and that includes women, unfortunately. So Seedrs came to be, and we've had some good success so far. You'll see we've raised almost £1 billion worth of investment in campaigns on the platform so far. That's been in almost 1,200 deals, and we've been able to back businesses right across Europe, and we've had pretty good success rate doing it too. And here is just a selection of some of the female founded businesses that we have raised for so far. So we've got everything from sustainable toilet roll to Japanese cuisine to being able to own part of a wind farm. And then we have one other company that is going to be joining our portfolio really soon, which is Sistrs, who are currently raising investment on the platform. They are welcoming, I think we're at 285 investors and counting. And we're really proud to be working with them. They're actually the first femtech business that we've had on the platform. And we've really loved being able to work with Claire and her team and having the opportunity to support them in a space that previously has been pretty underserved. And so, yeah, I'd love to hand over to Claire now to tell you all about who they are and what they're up to.
Thank you. So I am Claire Lettice, co-founder of Sistrs, along with Lucy. So my background was in marketing and brand strategy. Lucy was ex-buyer. and we started the company a couple of years ago. The focus of the company basically all based around our 3 pillars of products that are better for our body, better for the planet, and better for our sisters. So we have a give back impact part of the business, social mission, but we have very natural, sustainable products. And we launched with products, but we, as you can see from the slide here, have a big vision. So we are looking to combine the delivery of sustainable products with femtech. With smart delivery of those products. So that means creating technology that starts at its very basic form as logging period care products, capturing period cycle information, moods, all of the very basic type data that you might see in our current period type calendar type app out there at the moment. But the real vision is when you begin to capture not just data that is being collected and logged, but actually begins to actually feed back information on the back of that data. So for example, if you've captured that one particular month of your cycle, you were using a 3 light absorbency tampons followed by 5, that basically the delivery of that the next month could actually pop up, look, according to based on the data that you gave us for last month, maybe this type of combination of product might be better. And then over time, so we've got a sort of a 5-year plan, and the game plan there is to move into hormonal skincare and other areas, so sexual wellness, and yeah, link the whole thing together. So yeah, obviously all of that costs money. I'll stop there with the funding thing. We'll come on to sort of why funding in a moment. But yeah, I mean, our pitch is really combining our product set that we've currently got, which is our organic cotton period care range, and our self-designed and prototyped period cup called the Nudie. And then moving forward, we've got sexual wellness on the plan, period pants, organic lube over the next year, and then moving forward into potentially into hardware as well. Things like trackers and thermometers to track other aspects that can help with then both collecting that information and feeding that back and providing a whole knowledge network, as well as the delivery mechanism to send that product.
Yeah, absolutely brilliant, Claire. And I know from a personal perspective, you know, I was totally unaware of how many kind of waste products and chemicals and plastic go into these products that we use so intimately, and this, you know, this campaign was so eye-opening for me, and I think that I'm not alone in not knowing kind of the reality of some of these products that we use. So I think it's brilliant that there's people like you out there who are providing alternatives that are, as you say, better for the planet, but also better for your body as well.
Absolutely. Championing that cause is, I think, we think really important. Exactly. So we did, just for viewers and those who joined us out there. So when we started, and part through the work I'd been doing in my previous life, we did lots of research amongst women, and 80% of women don't actually realize that their current period care products aren't made from cotton. They think they're made from cotton, when in actual fact they are laden, as Catherine said, with chemicals and super absorbent polymers and plastic, huge quantities of plastic. So absolutely, the starting point from a product basis is always best in class, whatever that might be, whether it is our current range of period care or whether it's moving into vegan fair trade condoms or really sustainable period pants. The reason we've not launched, some of our competition have, and you'll see brands out there, is that actually the fibers and fabrics used in current period pants on offer are actually not that sustainable. They're actually fairly high in terms of oil based fibers. So we're looking and working with Leeds University, in fact, looking at different fiber technology, working with plant cellulose and things like that. So yeah, a lot of work to be done in some areas, as well as the sort of more ritzy smart tech. So yeah, a big journey ahead that needs money.
Yeah, yeah, absolutely.
Hence the crowdfunding, but yeah.
Yeah, I mean, yeah, absolutely. I mean, as I said, we are really proud to be working with Sistrs, and I know that you're going to be able to add a lot of insight on the investment journey as we kind of talk through it today, because you've done it before and you're currently doing it again. So yeah, I'm looking forward to hearing that. So if we turn to the investment landscape, when I was putting these slides together, I was like, I need to address the elephant in the room. And then I actually realized that there are two elephants in the room this year. The first one is obviously COVID. The global pandemic has had a massive impact to everybody's lives this year, both personally and on a business level. We officially went back into a recession here in the UK, which typically isn't a great time for business. But the investment landscape this year has been a really interesting one. I think everybody was knocked sideways when COVID first hit earlier this year, and lots of businesses basically had the rug pulled out from underneath them because they weren't expecting it. We know that on our platform, when it first happened, we definitely had businesses that were currently partway through an investment round who wanted to just close their rounds really quickly, get the cash in the bank, and come down and be able to kind of get on with things. And then we had businesses who were about to go live, who saw, they were about to launch their investment rounds. They just decided to press pause because they wanted to watch and wait and see what was going to happen. And for those first 2 weeks of that first lockdown, we saw investment on our platform absolutely fall off a cliff. I think investment activity went down to about 50% of where we would normally expect it to be. Thankfully for us, by the start of April, we started to see things pick back up again. And by mid-April, we actually had numbers back where we wanted them to be. And the Seedrs platform as a whole has actually been really resilient to the pandemic. And we're going to be closing out this year with investment levels up on those that we saw last year. But that hasn't been the case for every business and for every investor. I have certainly heard stories of angel investors pulling out last minute or trying to put in really difficult terms, or more commonly actually just delaying and delaying to the point where it becomes really difficult for the business because they don't know if they can rely on that investment, and they're coming to a point where they're thinking about potentially running out of cash if the money doesn't come in. On the institutional investor side, we've seen VCs typically focusing on their existing portfolios, which has made it quite difficult for any company that's coming in looking for new VC investment. It's been hard for them to secure it. But then on the flip side, we've had really brilliant initiatives like the government's Future Fund, for example, which we were really involved in. That was an absolute lifeline for a lot of businesses. For those that don't know about that, that was a scheme that was launched by the government and the British Business Bank, where a company could raise investment through a convertible note. And that basically just means it starts off as a loan and then it converts into shares in the company at some point in the future. And that investment could be matched 50-50 by the government. So we saw an awful lot of our portfolios coming back to use that. A lot of new companies were looking to use it too. Unfortunately, not every company was eligible for it. Some companies didn't like the terms of it. But as of 2 weeks ago, I think just under £900 million had been invested through this scheme, which shows that obviously an awful lot of businesses were able to benefit from it, and I think that's really brilliant. So I think it's fair to say that this year has been a bit of a roller coaster, and it's been different for every business depending on where they are in their life cycle and what they were trying to achieve. But it's certainly not all doom and gloom. Investors are still investing, even if they are investing in a slightly different way. It's just been about managing that and trying to figure out the ways to get the most out of it. I then move on to the second elephant in the room, and you may be wondering why I've gone with a picture of a penny with a slice taken out of it. You can't buy anything for a penny anymore. I think they've actually stopped producing new penny coins. But that's there to represent a statistic from the British Business Bank that has been around for a little while now and still hasn't changed. And that's that for every £1 of VC investment, less than a penny of that goes to female founders. Just let that sink in for a minute. It's 2020, and for every £1 of VC investment, female founders are getting less than a penny of it. Now, I don't want that statistic to put you off. I think if we're scared off by the statistics, then this will just become a self-fulfilling prophecy. But what I want is that number to kind of spark a fire in your belly to make you want to go out there and change that statistic. And hopefully by today, you'll kind of be more equipped to figure out how to go out and start doing it. So I think when we're thinking about investment, the first question to always ask yourself is, do I need to raise investment? This is a really important question to consider. Do you need to be taking on someone else's money and giving away part of the business that you're building? And this is something that a lot of people don't talk about. And it might seem strange for me coming from an investment platform saying, well, do you actually even need to do this at all? But I think it depends on what you're trying to achieve with the business, you know, what the current revenues look like, what resources you've got like yourself. And it's important to note that actually not every business needs to go out for external funding. You know, you can start small with a business, you can let it grow organically. You might not get the biggest and the quickest growth of the business, but if the aim is to allow you to work for yourself and to run your own thing, and you're not necessarily concerned with world domination, then perhaps you don't need external funding. You know, a so-called lifestyle business doesn't necessarily need external money all the time. Equally, if you struck upon a business idea that allows you to start generating revenue from day one, rather than having to invest in a tech build or actually creating a product, then you might be able to grow organically from this. Likewise, if you've got sufficient savings and you can pay the bills, or you can take out, you know, a startup loan rather than looking at equity investment, then you know, that might be the best route for you. But if that's not you and you need additional cash in order to grow quickly, to develop your products and your services, to build out a team, to start really marketing the business, then investment is probably the way to go. And Claire, I wonder if you have any thoughts on how you decided with Sistrs that you were going to go out for investment and when you knew it was the right time to do it.
Yes, absolutely. So, and I think it's very fair to say that it really depends on the area that you're in as to how and what type of money you need. So in actual fact, I started the business with Lucy, and we actually self-funded it for that first year. But unfortunately, the area that we're in is one that does need high capital investment from a product perspective, because the minimum order quantities of the products themselves, if you're actually producing, let's just say, the paper wrap for a particular tampon, you actually have to invest in, and I say invest because you actually have to buy the equivalent of 8 football pitches of paper. Those are the volumes that you deal in. Wow. And unfortunately, most people just don't have that type of money sitting there. And although I'd put in quite a big chunk, it really wasn't going to be sufficient to develop a wide enough organic cotton range that consisted really of 8 different product types, because you've got 3 absorbencies for a naked tampon, 3 for an eco-app tampon, 4 for pads, 1 for liners. So all of that, if you're going to brand it your own, then you need to have some capital investment. So rather than going out and borrowing a loan, we thought that we would turn to the crowd. And also, I think the thing to also view, depends the area you're in, but crowdfunding is also a great way of getting awareness for your business. So in part, it can to some extent be viewed as a marketing campaign, because you are going out there generating awareness for the business. So yes, we thought, I suppose mid-summer 2019, that we knew we wanted additional funding and needed to raise finance, and rather than going out and just talking to our own small group of friends and family, which indeed we did, and as we'll no doubt come on to talk, and Katherine will talk about it, in terms of getting that first chunk of money, even when you go on a crowdfunding platform, is very important. But we knew that we were going to go out and needed more money than we could probably source ourselves. We needed some external people coming on board. So we worked from, I guess, August 2019 through to, we actually went with Crowdcube, one of Seedr's competitors, the first time round. And we went out with a campaign that started in December 2019. And then the thing to bear in mind is that we actually were in a position, and this is actually, I think, one of the points that we're talking about is, you know, just about being investment ready. And one of the watch outs is that we actually, the great thing about crowdfunding and the great way in which the government can benefit small business raising funds on crowdfunding platforms is through SEIS and EIS funding. But there are a number of caveats around trying to get your investment money such that it is SEIS or EIS eligible. And we suddenly in December 19 came up against the fact that SEIS money, which is the most beneficial, tax efficient funding of money, is actually, it's capped at 150,000, and also you have to have claimed for it and applied for it within 2 years of your first invoice out from the business. So although we weren't really trading for 2018, we had issued odd invoices. And so unfortunately, we were suddenly in this position in December 2019 that we actually had to close the round by January. So we suddenly went on, we were originally looking at going for a larger sum than the target we went out with at 100,000, but we suddenly went out with that because we needed to close it really quickly around Christmas time. So for us, it was suddenly like a real last minute, oh, we've got to get everything now organized. Fortunately, since we had been working on the pitch and the deck and the numbers, we had that in place. But there were other things like the video, which obviously take a little bit of time putting together. So so that was, in a sense, why we decided to go crowdfunding. We wanted to get another community on board, or we wanted to have a place where we could talk to our own customers, but actually direct them to somewhere where they could put money into the business. That's the other great reason to crowdfund. It's actually a home for where people can actually go and place investment. Because if it's smaller sums of money, you don't necessarily want to absolutely get it in that direct conversation with them and have them as a direct investor. And moving forward, all of the conversations you might want to have. So if someone just wants to invest a very small sum of money, that is also the other reason why crowdfunding is so great, because it provides a home, a platform. It is a platform, but a home for where you can direct people to actually put in that investment. So is that sufficient, Catherine? Would you like have a little?
No, that's perfect for now. I've got lots of other questions to ask you as we go through, so that would be great. Brilliant. Yeah. So I think when you have decided that you want to raise investment, I think one of the next things that comes up is when you're going to do it, and you know, what the key milestones are. And you may have seen these terms thrown around. You know, I'm raising a pre-seed round. We've done our Series A. We're gearing up to Series B. And these terms actually mean different things depending on who you're talking to. I'm going to talk you through briefly what each one of them means so that you can start to debunk some of that jargon that I mentioned earlier. But my honest advice on this is not to get too hung up on these labels, at least not when you're starting out. You know, maybe at the point that you're out talking to institutional investors and you're looking at getting VC funding, you know, the Series A label, the Series B label becomes more important. But when you're right at the very start, you do not need to get hung up on these labels, or at least I don't think you do. So pre-seed investment is usually the first investment round a business will do. This will be a small investment round that really is there to take your business from an idea to a reality. It typically allows a business to build out an MVP, which is another acronym. Doesn't stand for most value player. It stands for minimal viable product. And essentially that's kind of like the first proper version of what you're building. If you get investment at this stage, it's usually from friends or family or small early stage angel investors if you're lucky. But to be honest, most businesses at this stage are actually, they're not ready for equity investment. And so bootstrapping the business as Claire did, or maybe taking out a startup loan or something like that might be the best way forward. Seed stage is the next one, and this is where I tend to work with businesses. The aim here at seed stage is to prove evidence of the product and market fit, and then to get your hands into as many customers as possible. If a business isn't revenue generating at this stage, which sometimes businesses aren't, the business should at least have a clear path to monetization so that investors can see when you're going to be able to start generating revenue. And seed stages typically range from somewhere between 150,000 to 500,000. At this stage, you're typically looking at engaging angel investors, equity crowdfunding, potentially some early stage seed funds or early stage VCs, although less common. And as Claire mentioned, there are usually good tax incentives at this stage, which will encourage investors to invest. And that can be really useful when you're trying to hook investors in to come in at an early stage when the investment opportunity is a bit riskier than it would be later on down the line. If you move on then to Series A, at Series A, a business is looking at significantly scaling. And this will usually be the first round that you'll start seeing VCs, that's venture capitalists, or institutional investors coming into play. And at this stage, a business will have a proven market fit. And this round will really be about scaling user numbers and revenue. So at this stage, a business will have a lot more metrics that it will be able to rely on. This includes things like number of active users or customers, user growth rate, customer acquisition cost, burn rate, monthly and annual recurring revenue. There's a whole load of things that people will want to talk through at this point. So it's much more data led rather than being about the vision and the dream and the goal for the business. And the range for a Series A round tends to be usually between 2 million and 10 million. Investors at this point, usually you'll still get some large ticket angels coming in. You're looking at VC investment quite often. Equity crowdfunding platforms are usually quite active at this stage because the companies will typically have a large community at that point that they'll be wanting to engage by giving them the opportunity to invest in the company as well. And then we move on to Series B, and this stage is all about scaling as quickly as possible. So raises here are much more significant. You're looking at between like 10 and 30 million, with some outliers much higher than that. Revolut, when they raised with us, was at a Series B level, if that gives you some idea. And investors at this stage is typically just VC, institutions, and equity crowdfunding. But I guess the point I want to make on this bit is that the path to funding is not linear. There is no like blueprint for raising money. It's not you do your pre-seed at this point, then you wait 6 months and you do a series, you do a seed round and you raise X amount. It just doesn't work like that. And I think particularly this year, if anybody was on kind of a roadmap like that, I assume that's been thrown out of the window. Lots of businesses will do more than one seed round. Businesses will do something called a bridging round, which is where they're sort of in between seed and Series A, not quite at the metrics that they want to get the VCs involved. And yeah, I mean, Claire, I don't know if you have any thoughts on these labels and whether you need to be too hung up on them, but my opinion is certainly that be aware of what they are in the different stages, but don't get too concerned about, which stage you're at.
Yeah, absolutely. And I think also there is confusion as to, in a sense, as Catherine said, as to whom you're talking to, because Series A and Series B is very much VC terminology, and even smaller investors, because we've on our second round, they say, well, is that a Series A round funding? And it's almost like, well, it's still a very small raise. So although it's our second equity funding round, our first, as I said, was the 100, but we got close to the 200, and this one was 375, but we're hoping towards 500. So even that, though, people are saying, well, is that Series A? And it's hard to actually, because although we have a plan, we're actually thinking that towards the end of next year, the beginning of the year into 2022, we will probably go for another raise. So that's what we internally are thinking in terms to actually get to full profitability. That's what we're going to be needing. But it's like, exactly, you almost get, depending on who you're talking to, you almost get forced into trying to describe your raise by one of these terms. And it's, as Catherine said, it's not really that easy. And it's almost like looking at the sum of money you're getting and where you are on your journey and what you think you will need to get to the next stage. And also, as Catherine said, the people would look for some of those quite hard metrics for a classic Series A raise, but similarly, even for ours, we're getting asked lots of those types of metric questions, when the reality is we've actually not done that much testing and test and learn. So we don't have a lot of money, because we've actually, particularly during COVID, and okay, an example of the year, we've actually not spent a lot of external online marketing funds. So we actually don't have a lot of those numbers because we had to conserve cash because we had no idea what was going to be happening. So we didn't want to go out and actually just spend the money in the hope that if we did attract a particular customer from a lifetime value perspective, they would come back, because you just didn't know that. And so any lifetime value figures are also have been really hard to craft. So I think there are challenges there. As Katherine said, really, depending on who you're talking to, and you almost have to work with their terminology and sort of express what you're doing and how you see your own raises and the numbers attached to those, and let them put that in those numbers into their own terminology. So
yeah, absolutely. I think that's really, really good advice, actually. Brilliant. Okay, so we've decided that you're looking to raise money. It's worth me very quickly just running through your options. Some of these people will be familiar with, but so you have debt. That can be a really attractive option because it means you don't have to give away any of the company. But as I mentioned earlier, lenders are less likely to lend to early stage businesses. And also you have to find a way to pay it back with interest at some point as well. There are also grants. These are a really great option if you're eligible for them, because it's money that you don't have to pay back and you don't have to give away part of the business, which sounds great. Perfect. Get everyone a grant. Unfortunately, there are not that many of them. They don't apply to every business. And for those that do exist, they're really competitive. But it's definitely worth looking into, particularly if you're in a business that there's a lot of research and development involved in what you're doing. Then definitely one that's worth exploring. The next option you might think about, you might have heard about, is rewards-based crowdfunding. This is generally where backers will pledge their support, and usually they'll be prepaying for a product, but they're not getting a part of the business. This can be good for cash flow, particularly for early stage businesses, but because backers are typically just prepaying for a product, you're not actually getting funds in that are there for the growth of the business. They're paying off for the products. And amounts raised through these platforms can also be relatively low because of that. But again, it depends on where you are in the stage of the business. If you're really early stage and you've decided that you actually need £5,000-10,000 in order to get yourself off the ground, then rewards-based crowdfunding might be a really good option, particularly if you're a product-based business. And then you have equity. And this is where people will invest money in a company in return for shares in the business. So investors are looking for a long-term return on their investment at this point, usually somewhere around the 7-year mark. And they'll usually get their money back when you get to the point where you can sell the business, or maybe you're making profit and you're declaring dividends and you're repaying profit back to shareholders at that point. Equity investment can come from a number of different places, but typically it's coming from either friends or family, if you're lucky enough to have friends and family with available funds. It's coming from angel investors. These are individuals who will invest significant tickets into the business, and usually they'll also be on hand to offer advice and support and expertise and contacts. So usually they'll try and be a bit more hands-on with the business. You have VCs and funds. So these are, again, professional investors who are investing large amounts of money, and typically it's a kind of a vehicle that's investing somebody else's money. And then you have equity crowdfunding, which is what we do at Seedrs. And this is usually a combination of all of the above, plus you get to build out, as Claire mentioned earlier, a community of investors and really engage your customers, your users, your followers, and your supporters from £10 upwards. Now, Claire, we touched on it a little bit earlier in terms of kind of why you chose crowdfunding, but yeah, I guess it would just be helpful to get a bit more insight from you in terms of why you landed on crowdfunding rather than some of the other options out there, and what you're hoping to achieve with this pool of, we've got hundreds of investors in your business now.
Absolutely. So I guess just to recap, so obviously it was in part self-funded, which in a sense is therefore a non-payable back loan, really, ultimately, until the company does generate profits, which is a form of debt, I guess, to some extent. I think, as I touched on earlier, in terms of recognizing that we wanted to get friends and family involved, we, for our first raise with Crowdcube, recognized that friends and family just weren't going to deliver. We don't have wealthy enough friends or those with the available cash to fund the business to the level we wanted it. So that was the reason the first time we went with the crowdfunding. First time round, we also, again, because of timings, we didn't go and reach out to angels, and that again was really that timing because of the SEIS. Now, interestingly, this time around, so we were in a sense with the luxury of time, I guess, this time around. We knew that we, at the beginning of the year, were going to go for another crowdfunding round. I think we'd already said we would do crowdfunding because we already had, I think what happens is, even if you move forward and decide that you are going to get other angels, other VCs on board, because you have already done any crowdfunding round, you will always have that community. So I guess we always felt it was likely that we would do some second crowdfunding round, or at least involve them, because obviously we had that 120, in fact, in our instance, investors who we actually brought on board in our first round. So we wanted, again, to actually go back to them. Now, we could just have offered that as some sort of preemption rights, but we actually wanted to get them on board in a bigger way with another crowdfunding campaign. So we very early on reached out to them to say, look, this is what we are going to be doing, and asked them if they would like to come on board in from a direct investment perspective, as well as a smaller amount through our crowdfunding. At that stage, we hadn't decided on Seedrs, but we were talking, and we spoke to both. And I think the reason that we went with Seedrs in the end was that we were super impressed with the team of Katherine and her colleagues, Theo and Michaela, and just thought that it would be something different. There'd been a couple of other companies in our space, competitors, who had recently been with crowdfunding, and we felt that we should maybe mix it up a little. So I think when you're looking at crowdfunding, that's the other thing. It's like, you know, there's a sort of, it's pros and cons. Do you go with a company that has lots of expertise and experience and they've been doing lots of those, or do you actually try someone new? So we always like to try something new. So we thought, okay, we'll go with Seedrs, untried, but we're going to do this. So we knew that we wanted to do the crowdfunding. But this time round, we actually did start to go out and approach angels directly, because we recognized that we wanted slightly higher investment than the first time round. And therefore, we were going to put quite a lot of effort in ourselves and approach angels direct. So we went out and reached out to a large number of angel investments. I think, unfortunately, angels at this moment in time, almost as Katherine alluded to, either have been pushing back or just don't have funds, or are just go. So the angel pitch has been incredibly tough in the climate that we're in at the moment. I don't know if that is just the climate or whether or not it's our particular business pitch. Of course, we'll never know. But reaching out to angels has been harder, I think, than we thought. Although we have had a lot of feedback, have said, from angels who said, I'd love to invest, but I just don't want to invest at this moment in time. So we're hoping that it really isn't our pitch and it is timings. The thing, though, for us interesting on VCs and bigger funds, and I think this is true of any startup, is that a large number of VCs and funds don't really consider businesses unless you've got £1 million worth of revenue coming in a year. And that, for us, meant really we had a lot of very abortive conversations. So we've had lots of conversations with VCs, but a lot of the feedback is, come back when you've got £1 million of revenue, basically saying, when you're a true and tried and tested business, which is like, no, we need to get that. So the VC funding actually is a very, it's very easy, I think, if you want a big sum of money for a big vision, and almost it's easier to get that on a vision than it is on a smaller track record. So if you've got a business with a track record, but it's not great in a sense that, you know, it's not been going for that long, and your sales revenue is only, as ours is, close to the 200 mark, then it's really hard to actually get VCs to buy into, even if you have got the vision that we have. So it's interesting. So I think we early on recognized that we would be doing this crowdfunding, and maybe our view has changed on what our that we've said that we're looking at a third round next end of next year, the beginning of the year after, and maybe it's going to be a bigger number than we'd even thought at this moment in time, simply to be able to sell the vision to VCs, because I think that is what they're looking for, they'd almost rather give a really big chunk of money and make the business a success than a smaller chunk of money to almost tide you over. So that's our learnings actually, of which has been quite useful, having this second round, because in a sense, as Catherine said, there's no right or wrong or which way you go. And actually, the more you go out talking to potential investors, the more you learn of actually how you could change things and how you could alter, not necessarily your pitch per se, but recognize what different investors are looking for and the way in which you can approach that or not. So as I said, originally we were thinking, yeah, we'll go out for a big sum of money, but this now, having had these comments, we're thinking actually we should go out for a really big sum of money, and really just because actually the next time I think we view it as almost absolutely selling the vision in a much bigger way than we have done this round, whereas people are really still buying into our product. We're still developing our product is not fixed, and so in a sense we're a product business at the moment that's looking towards tech, and a lot of the questions that we're getting in terms of investment, we started on very much and our journey even with Seedrs actually has changed, because we started very much pitching our vision and recognized that this business at the moment is actually a product business. So we've almost retrenched to getting people involved in wanting to actually get hold of our product and buy into our product rather than the vision. So again, there are all learnings that you know, until you go out and talk to people, so I think you have to be flexible. I guess that's the point about all of this. You have to just recognize that, and you won't be the business for everyone. You again have to recognize that that people will invest with hearts and minds, and different investors have different. Some, if they're very numbers driven, will absolutely interrogate your numbers to the nth degree. And if you're a tiny business and you've not done much test and learn from a D2C perspective, then you're probably never going to turn them around. They actually have to believe that that you're benchmarking correctly against competition, that if you've got industry benchmarks, that's a great way to pitch what you believe is possible. But and that is the only way to pitch if you've not got those real facts. So, and some people will buy into that, and some people will say, well, that's just blue sky. And you just have to push forward on all fronts.
Yeah, absolutely. I think the point of being flexible is really important. I think just when you're running a startup generally, you have to be flexible because you don't know what's coming around the corner. But I really love the ambition of, next time for the next round, we're just going to absolutely go for it because why not? And I think, when you look at kind of the statistics on investment rounds and things like that, that female founders tend to raise smaller amounts of money. And sometimes it gets put down to a lack of confidence or a lack of ambition, and I don't think that's the case whatsoever, actually. But yeah, I love to hear people like you who are just saying, look, we're just going to absolutely go for it. We know we can deliver it. We know we can do it. We just need to get there.
No. But picking up on that, to some extent, I think it is that it's just a state of realism. And I think that, those really big chunks are interesting. You probably pulled out by men who just think, look, we're going to pitch this and go for it. And women actually are like, well, can we really say we're doing that? And actually this time around, what I've learned is actually, yeah, we could say that. We could actually have that vision there and actually just pitch that. Whereas it's always like, yeah, well, I know if we spend, £500 on this, what it buys. And yet, guys, they do have a very different perspective of how to invest. But I think at the heart of it is, there is one really interesting conversation with one particular potential investor who said, look, VCs would really much rather give that absolute big chunk of money to make the business a success than smaller amounts of money that might just see you through. And that has really hit home. That so it's almost like you can either bootstrap and really do it in your own way, or otherwise you absolutely have to make sure the business is going to succeed. And sadly, part of that often is having the finance to be able to do it.
Yeah, absolutely. Well, I think that brings us quite nicely to kind of the next point where, we've decided we're ready to go and raise investment, but how are you going to do it? And where are all the investors? I pulled this slide from a presentation that a colleague of mine did a couple of weeks ago, because I was just shocked at how white and male it was. And then I remembered that I shouldn't be shocked by that, because I imagine if I asked you to close your eyes and imagine an investor, then it probably doesn't look too different to what I have on the screen here. People think that this is what investors look like and what people have to do when they go out to investment. But I have an interesting statistic for you, which is that, at least from our experience, 95% of the time, the first investor in a business is somebody that the founder already knows. And that's something that really comes into its own when you consider crowdfunding, because you can pull together absolutely everybody you already know and anybody who already knows the business and have them invest as much or as little as they can to help you get off the ground. Now, I've mentioned crowdfunding a couple of times, and I just wanted to talk you through kind of like a quick one-on-one of how it all works, because I mean, crowdfunding is a really brilliant way to tell your story and to engage a pool of like-minded investors. And in an ideal situation with a crowdfunding round, you end up with your existing customers and followers and supporters who will become investors. And then you will have new investors who will become customers and real brand advocates for the business. And the way you do this, as I say here, is by pooling together all of your different resources. And there are really three main pillars of a crowdfunding campaign. There's your private network. So that is investors that are known to you personally. It might be friends, family, professional contacts, angel investors that you've been speaking to. You have your business community. So that's your customers and your followers. And then you have the Seedrs investors. And all of these three things together is how you hit your target on a platform like ours. Now, one of the key things that I do with businesses who are first thinking about raising investment with us is to map out their network. And I don't know how many times I have been told, I don't know any investors. I'm constantly telling entrepreneurs to unthink anything that they thought they knew about who an investor is. Because with a platform like ours, it's absolutely anyone who has ever shown any interest in what you're doing whatsoever and has at least £10 to help support you. Now, granted, you're going to need a lot of £10 investors to get to your target. And so when we're mapping out your network, you want to be looking for people who can put larger tickets in as well. But quite often, when there are not people in your immediate network who are those investors, you need to find a way to leverage the networks of your networks. And that's how you get there. And that's how you meet people. So, you know, your personal network, your personal support group, your community on a personal side is often what helps you get through to get those first investors who are going to come in and back your business. And so here's some tips, really. I mean, when you're working with a crowdfunding platform, you'll hear us use the word momentum a lot. We talk about momentum all the time because that's what drives investment into a campaign on a platform like ours. But that starts even before you launch on the Seedrs platform and when you're having your initial conversations. And I'm letting you in here into some of the strategy calls that I have with businesses. But, you know, really the things that you want to do is as I've outlined here, you want to build scarcity into the round. This is how we get yeses in the first place, and then how you build on the yeses that you've already got. So we do that in two ways on our platform. We set an investment target and we set a time limit, which for us is 40 days. And so if investors know that there's a limited size of the round and that there's a limited time frame for them to come in during this round, or they're going to miss out, that's actually a really big kicker to make those investors who are being slow get over the line. And we think that's one of the things that's been particularly helpful on our platform this year, as we've heard stories of, you know, offline investors who are being really, really slow and taking longer to get to a yes. If we create some sense of urgency, if there's literally a ticking clock on the campaign, that means that investors know that if they don't invest now, they're going to lose out. The next thing that we look to build in is a sense of FOMO, or fear of missing out. So for example, if you let investors know, or potential investors know, that you've got 7 other investor meetings signed up that week, if you genuinely do, you know, that is guaranteed to make them sit up and listen. You know, oh, there's other potential investors. Maybe this company doesn't need me as much as I thought they did. And even if the opposite is actually true, you know, if investors know that there are other people involved, it's likely going to make them pay more attention to you and pay more attention to the conversation you're having now, rather than putting it down to the bottom of their list. Then another good tip is, if you've got someone who says yes, who has a bit of clout, also let people know. So for example, if you're a food and beverage business and you have someone, you know, high up in delivery, for example, who's going to invest in your business, that's a really great endorsement. And again, it will get people to sit up and pay attention. So if you have industry specific people, or people with a lot of experience, or known angel investors who've, you know, agreed to back you, use that and leverage that. And if you haven't got any meetings or any yeses yet, you know, there's still ways to do it. So you can let people know, for example, that the next round you're going to go out to VCs, it's going to be institutional investment. You can't guarantee room in the next round. And so if they want to be involved, then this is their only chance. They've got to do it now. And then for the people that you're speaking with, don't speak to them just once and then drop them if you don't hear back immediately. I always recommend putting those potential investors on a list and then keeping them updated. So whether it's an update on the round, whether it's, you know, a business update, if you've hit a significant milestone while you're in this initial phase. And even if you get a no from an investor initially, ask them if they're okay, if you keep them updated as how things are going, because you never know. Their circumstances may change. You might hit a new milestone that might change their mind, or crucially, they may know someone else who might be interested. And so if you're providing them with updates of how well the round is going and how well the business is going, it might just spark something in their mind that makes them share the opportunity with somebody else. And that may be the person that gives you a yes. But one key point that I want to make on this is when you are out speaking to your network, speaking to early stage investors, you want to
she did this yesterday. I think her computer just goes off.
As possible, because
Catherine,
you'll have minutes. Get to answer quick.
Catherine,
out that answer to me is completely dead. You then get to crucial questions at that point, feel a bit bad because they've you.
Catherine,
have I gone?
You went all for about a minute, so just start that bit again.
Am I back?
Yeah, you're back.
Goodness, my internet. I think this is the problem with everybody working at home. Everybody's on the same bandwidth, and it's yeah, not brilliant. I don't know where I cut out then.
Not sure. You were gone for about 30 seconds. That was it.
Okay, I'm sure I made that, kind of got the most of my point across, but I mean, the point that I was really trying to land there was that when you're going through this process, if you're getting kind of one key tip that I would suggest you take away from this is you want to get to a yes or a no as quickly as possible, because if you're stuck on a maybe, then that's going to kill your round because you have no idea if you can rely on those people or not. And even if you want to push people to get to an answer as quickly as possible. Even if you get to a no, it means that you can then ask the crucial next question, which is, well, okay, but do you know anyone else who might be interested? And usually at that point, investors will feel a little bit bad because they've said no to you, and so they'll want to help you out a little bit. So, you know, if you can play on that a little bit, then, you know, you might as well try and get something else out of the conversation. Yeah, I mean, good. So now we'll move on to, you've managed to get some conversations with investors, you've managed to get some people who are interested, you've got meetings, you've got calls set up. I'm going to run you through really quickly what investors want to know. And it's worth me saying that every investor is different. They will put more importance on different things depending on who they are, what their experience is, what your business is, and how much they're thinking about investing. But these are the things that I always look for when I am evaluating an investment opportunity for our Seedrs audience. If you're looking to raise investment, the first thing that any investor will ask you for is a pitch deck. And your pitch deck is essentially a written presentation that will help investors to understand about your business and why you're raising investment. There are lots of conflicting views on pitch decks, how long they should be, what they should include, how many years worth of financial forecasts to include. But I think it's worth remembering that a good investor won't invest just off the back of a pitch deck. The pitch deck is really there to help you to secure a meeting with an investor, and that's when they'll be able to delve deeper and ask you a ton of questions. And it's for this reason that I always say your pitch deck should be clear and punchy. And I always say I like to be shown and not told. I don't want a pitch deck that's just full of blocks and blocks of text. I want to get the key points out really quickly, because I can ask lots of questions on a call. And your pitch deck should largely cover the other 7 points that I have listed here, as well as how much you're looking to raise and what you're going to use that money on. And I'm just going to run you through the rest of my list here really quickly so that you know why they're important. The numbers can seem like quite an obvious one. You need to know your numbers back to front and inside out, because investors will ask you about them and will ask you to back them up. And now, as Claire mentioned earlier, that can be slightly challenging when you're at an early stage and you're You don't have a ton of revenue to point to. You don't have years and years of data and figures to point to. But take the data that you do have and make sure that you understand it. So this relates to both your forecasts, which are really tricky because they're based on a whole load of assumptions, and your valuation, which again is very difficult when you're an early stage business. I'm asked about this all the time. I'm constantly telling people it's an art and not a science. There's a million and different ways that you can value an early stage business. And you want your forecasts to be bold and exciting, but also realistic. Go too conservative and you run the risk that investors just won't be excited by the opportunity. Go too wild and they think that you've just plucked the numbers out of thin air and they just don't trust anything that you're saying. They'll think that you're delusional. And so you really want to try and find a healthy middle ground there. And the numbers are important because quite simply, they set out what your investor is getting for their money on day one, and then also what the potential return is that you think you can deliver for them. The next one I've got there is the market opportunity, and largely this is important for the same reason. So, what's the total addressable market? What percentage of that do you think you'll be able to capture and why? Every investor will want to think that the companies that they are investing in are going to be the next big thing. And so if the market opportunity isn't big enough, they just won't get excited by it. And I think you've probably seen that one on Dragon's Den, that that reason comes up all the time. The market's just too small. This is too small for me. So you need to really establish your market. Then once you've established your market, how crowded is it? Are there competitors already out there? If there are, what's your USP and how do you differentiate from them? Chances are there will be people out there doing similar things from you, but it's really what differentiates you and what makes you special. What's your secret sauce that means that people should invest in you rather than in somebody else? And yeah, if you don't know your competition inside out, then you'll never be better than them. So make sure you know your competition, because investors will ask you about it. The next one is traction. This is quite a funny one because I'm asked all the time, how much traction do I need? And unfortunately, there is no cookie cutter response to that. Every business is different, and that seems like a bit of a cop-out, but it's true. But it really depends on the market and the offering. And by traction, we're talking about the data points in the business, but essentially we're talking about progress. So it might be the results of a pilot or a beta test. It might be the total number of downloads or the number of subscribers, active users, total customers, Trustpilot ratings, revenue if you're there. But yeah, understanding no matter how early on in your journey you are, understanding what progress you've made so far and being able to talk about it is going to be really important for your conversations with investors. The next one for me is community. This is really important for crowdfunding, as I mentioned a couple of times, because I want to know if your community will back you as part of the round. But community also means engagement, and that's really important to any investor, regardless of whether they're a crowdfunding investor or not. And because really an engaged customer or user base generally means more revenue and more brand power. So we'll want to know about that. The next one for me is team, and I've put this one in bold because this perhaps should be higher up the list. For me, the team is one of the most important things when you're assessing an investment opportunity. So when you're at seed stage, which as I said earlier is where I operate, you don't have a whole load of data points, and quite often you don't have much, if any, revenue. And so at this stage, I'm looking for an experienced team who I trust will deliver on the things that they say they're going to do. And by experience, it's worth me saying that I don't necessarily mean that you have to have 20 plus years of business experience or running, previous experience running a business. If you do, then great. But it can also just mean a deep experience of the pain that the business is trying to solve. For me, that's just as valuable. And finally, I want to know what's the end goal. What are you hoping to do with the business? Where are you hoping to take it? And how are you going to achieve that? That's really important for both the business and the investor, because you're essentially getting into a long-term relationship with your investors. And if you're not aligned on where you're heading, then it's only going to end in heartbreak. So yeah, I mean, that for me are the key things that I look for. I'm sure everyone's keen to hear from you, Claire, on the things that you did to get investment ready and your insights on raising investment generally. I know I'd also be keen, I guess, to hear from you on how you found it raising as a female founder, given the stats that I mentioned earlier, but also pitching a female-focused brand and whether that has had any impact on the way that you've done things.
Yeah, absolutely. So I think if we just flip back to Catherine's slide for a second, just looking at all I would say is looking at everything in the early part here, the pitch deck, the numbers, the market opportunity. I think in a business, obviously when you're just running it and you know, if you're a very small startup, it's very easy to have internal knowledge that you don't necessarily capture. And the key thing I would say is when you're coming to pull your pitch deck together, the numbers, the forecast, the valuation, ultimately every investor, and specifically when you go onto a crowdfunding platform, because the crowdfunding platforms do their due diligence, you need to support every fact that you say. So it's really worthwhile as you're running, when you're starting your business, as you're going through, just to begin to capture any points, like, you know, if you do tests on stuff, if you have feedback from customers, if you've got some market information that you heard or gathered or just saw, that found somewhere, to capture it at that moment in time with the link or the reference, so that you can come back and use that in later time. Because your pitch deck and your numbers should all be sourced, and you know, you should have that watertight case of every fact figure that you're talking about. And similarly, from a competitor perspective, if you've been out gathering information, if you're a D2C business, and if you've been capturing competitive and sending away for their product, it's just worth capturing it all as you go along in one place, so that later in time you've got it all together. That can take so much time. We learned that the hard way for our first crowdfunding raise. So this second time we were in a good place, because we knew, you know, we knew we had to update some of our numbers to get them just more pertinent to the current year and so forth. But basically we knew really what it was that we were saying and where our market figures were coming from. We'd spent days in the British Library gathering our stats and stuff like that. So you know, it's good to actually just begin to make a point on that. So sorry, now we can flip to the next slide. So yeah, so obviously building the team, it is, as Katherine said, really it is super important. We started the business, it was for about 6 months, purely really myself, whilst Lucy had a day job, and then Lucy came on board. Lucy is the lovely lady on the left hand side of the picture that you see. So Lucy came on board, and then for a while it was the two of us until we got funding last December, and we then were using freelancers to, for example, help us with some of our social media content. So I think this is now really the image that you see here, the pic here, is now full-time, everyone coming on board post-investment. Izzy, wearing the white blouse, she's our head of Sistr Happiness. She's been on board since just as COVID hit, and her role, she's a really enthusiastic, real people person. She interestingly came on to help us with store demonstrations with and events with, for example, the nudie period cup, to actually do demonstrations. Of course, COVID hit, so she's really much more moved into a head of Sistr Happiness. So lots of we get an awful lot of queries and questions about our nudie period cup before sale, so pre-sales commentary, and then obviously post-sales as well, and then onboarding our B2B retailers. Emily, the lady in the mustard top, she is now our head of sales, business development. She came on board only really recently in September, and weirdly, we've met 3 times in person around socially distanced tables, but she's currently working up in the northeast, and you know, total remote working. And I think that's one of the other things about this year, that it's been really hard to build a company culture as you might like, because although we had investment, we really wanted to get our own office space and bring everyone together. We did actually take out our own office in a co-working space in March, but we actually gave that up in June, having not, you know, only spent a quarter of our time there. But you know, stuff happens. And then Charlie, who is coming on board fully, he helped me pull together the numbers for the first raise. That's the other thing, that going for funding is quite financial intensive in terms of getting your numbers right. And although I am okay with numbers and, you know, adept at a spreadsheet, if you can actually simplify your forecast figures based on different it makes it so much easier. And Charlie came on board. Well, sorry, Charlie didn't come on board. Charlie helped me with the first raise, and then this time is now actually coming on board. So he's been helping with fundraise, and when we post investment, he's coming on board. And his background is very much in startups, fintech and consultancy. So he sort of adds, he's also a boy. We've always said we're female led and female founded, which we are. So he's now our first boy on board. So that will be very interesting. So has that covered off everything? Did I miss anything there?
No, I think that's everything. Yeah, I think we've covered off an awful lot today. I appreciate we've thrown a lot of information at people who are listening. But I think that's pretty much it. So if anybody's got any questions, very, very happy to take them.
We've got one, Michelle's question. Did you develop a menstrual cycle part of the app in-house, or did you API lease that from other companies like Flow or Ava? And
yeah, exactly. So that's what we're looking at now doing. We actually haven't got that up and running, and we are going to take the first few weeks, as soon as we're post investment, to actually consider which way to go. We will probably develop it in-house. We've actually, in our plan, we've costed out for a development team. But when I mean in-house, that either might be absolutely in-house or working with external agency developers, or, you know, developer external to us, rather than partnering. We have and are still considering the partnership route, but we want to own the IP. I mean, I think, you know, it's always tricksy, but I think if we've got really big ambitions, we need to begin to think about the IP ownership, and it's definitely something that investors have asked us, and so we're quite keen that we do try to gain as much IP around everything that we produce as early as possible.
okay, cool. And also both, yeah, a question for both of you, probably Catherine, you probably will have answers about valuation. I know when we went down the route, the Seedrs route of getting something valued which had brand value and membership, but then you have something else on paper, cash flow wise, it's sort of it's not that, yeah, it's not as clear cut as some businesses. A lot of businesses are, that's what you on the paper, you can see the revenue, you can see everything, you can work it out, but there are some, yeah. So what are your, what's your advice on the different approaches?
Yeah, absolutely. I mean, as I mentioned earlier, there are so many different ways you can value an early stage business, and it's really difficult, particularly, as you say, when there are value in things that don't necessarily work their way onto a balance sheet. But it's tangible, it's there, it exists. It really depends on what sector you're in. There are some sectors which it's a bit more clear cut. So, for example, when you're in the food and bev space, if you're an FMCG brand, there are pretty kind of established now rules that typically you're looking to value yourself at somewhere between 3 and 5 times your annual revenue. That is pretty accepted. Across other industries, those rules don't exist. And also there will always be outliers, right? So one of the things that I always say to businesses when they are thinking about where to value themselves is to go through a benchmarking exercise. So take a look at other businesses that are either in your space or that are kind of across different verticals, but have, you know, there are comparable things that you can compare yourself to. Look at what they valued themselves at when they raised investment at various stages, and then figure out how you differ from them. So is there something that's, you know, are you in a particularly hot space now? Have you got a particularly experienced team? Have you got really good signs of early traction, even if nothing has actually been executed upon yet? You know, do you have contracts signed, but you haven't fulfilled them yet, for example? And then you'll be able to figure out where you sit within the bracket of other businesses that have already raised. But yeah, I mean, if you take a look at the competition and see where you sit against them, that's probably the best place to start. And then you can then looking at other models and start looking at other models and other ways to try and land on a number that you're comfortable with.
Cool.
I've got a question. You know, when you're bootstrapping and you've got friends and family involved and it's all quite informal, would you recommend having documents and things in place? And if so, are there places you can get basic documents to do that with, or is it just still an informal thing?
Yeah, I mean, it depends, and businesses will take different approaches to this. I would always say, maybe this is because I'm coming from a legal background, I would always say put documents in place, because I've seen when things go wrong. I had this quite recently, actually, with a business that I've been working with who's been looking to raise investment. They signed a one-pager with their first investor about 8 years ago. That was, you know, they were friends, they were work colleagues, it was all done on a very casual basis, but they signed this one pager because they just wanted something in writing. They thought they should have something down on paper. Turns out that they actually gave that investor a veto right on them raising any other investment in the future. This company had managed to do quite well organically, and they hadn't needed to raise investment in the past 7-8 years. They then were looking to do it now because they got to a point where they, you know, they had a clear plan, they had a new opportunity they wanted to take advantage of. And then this investor, who once was a really close friend, people drift apart, they just hadn't been in touch for years. He said no. And he said he basically didn't want to put any more money in, but he also didn't want to be diluted. And he said, you know, I've got this piece of paper that you signed, so tough. And it's turned into this whole nightmare, and the business is now trying to figure out a way to untangle it. If they'd taken advice at the time that they did that, they never would have signed that. So yeah, I mean, I think actually my actual answer to this is probably either don't put anything in place at all, or do it properly. If you have a halfway house, you're just going to create a whole world of problems for yourself.
Well, that is actually going to be my other question. So are there things that you would advise if you're very, very green and naive and going into this investment process? First off, are there things like that are kind of your checklist of make sure you've got this in place, make sure you know about that people might get taken advantage of otherwise if they're not aware? Are there some pretty big flags to pay
potentially
attention to?
I think it's things like that. So it's investors wanting particular controls or veto rights over certain things. If someone's coming in and putting kind of 10%, getting 10% of the business on day one, sometimes, as in this case, they didn't want to be diluted. So it meant that they would always have 10% of the business, regardless of how big it grew, without putting any more money in.
Wow.
Basically kind of like fetters and controls on the day-to-day running of the business you also want to be careful about, depending on who the investor is. What I would just say is, if you have an investor who is asking for something in particular, just go and take advice. There are so many people that you can take advice from. There are organizations who are very good, who will prepare documents for you that are, you know, they're aimed at startups. And so they're costed out for startups. And so it won't cost you, you know, sometimes people think using a lawyer will cost you thousands and thousands of pounds. Sometimes it will, but there are other options out there. And so, yeah, I mean, if someone's, one of the things that I think has come up in a couple of the webinars that you've done actually is trust your gut. And if something doesn't quite feel right, chances are that you know that it's wrong. And so if something feels a little bit off about something that someone's asking you about, then just ask someone, whether it's you formally go and instruct someone, or you find someone to just say, can I just run this past you? Because chances are, if it's something as big as, you know, they get a veto right on anything you want to do in the future, then someone will be able to say, absolutely don't agree to that, without putting too much time or effort into it.
Cool. The MVP people always ask, because it's sort of a lot of time it's a case of needing like sort of 10 to 50 grand to get it all, especially if it's tech, and that's sort of it's a little amount to go down the seed route. Or what's the advice on getting, where to get that from?
The money to build out the MVP. That's really difficult when you are trying to kind of build out some tech, because it does usually require more money than people kind of immediately have available to them. Sometimes it's things like seeing if you can take out a startup loan, if you can get enough to cover it. If you do have friends and family who have resources available to them. Other times it's things like, I've seen people take on kind of like a CTO, or kind of a techie person who can essentially build it out, and they're not looking to be paid for it at that point, because they're going to get ownership in the business. So maybe they'll be given something called sweat equity, which is essentially they get shares in the business for the work and effort that they put into it. But it's difficult, and that can, you know, quite often be, it's quite a big hurdle to get over with when you've got that idea, but you know that it costs a certain amount of money. But I just think that there are lots of organizations out there. You know, I mentioned kind of in our webinar yesterday, there are accelerator programs. There are things that are there to help people get off the ground. when they don't immediately have those resources available to them. And so I would really recommend that people just get out and speak to as many people as possible and just try and tap into some of those resources because they are out there.
Cool. Does anyone else have any, do you guys have any more questions? If not, we'll end it there, and this will be live on our YouTube tonight, so you can go back and listen. And but if anyone has any questions for Katherine or Claire that they suddenly think about, then email away.